Hello, this is Jordan Lawrence with the Lawrence Perspective. And today, after my last conversation, which was around kind of the esoteric discussion around inflation and all the mechanics of how inflation happens and how it affects markets, I want to zero in on something that's a little more volatile and will get a stronger reaction maybe from a number of people, and that is to talk about cryptocurrencies, which of course cryptocurrencies are in an interesting time here. I actually been wanting to have this conversation for a while, but didn't feel like the time was right because we were in such a mania and there was so much emotion around the space, and we probably still are in a mania and some level of a bubble. But the space has collapsed over the past week, actually, by 40 to 50%, depending on the protocol you're looking at. So, I'm going to talk broadly about cryptocurrencies, but I am going to zero in on some specific protocols. I think there's just a tremendous amount of misunderstanding, really on both sides of the opinion scape here, where you have people that say this is a total ridiculous bubble and a mania, and how could this possibly be happening? And then you have people saying this is the future, it is everything, and it'll go to the moon forever. And they both miss the point. Likewise, I hear things on Bloomberg Markets every morning when I listen that just suggests a tremendous amount of ignorance about the space and the phenomenon and how it can be looked at in the context of manias and bubbles, which are a core feature of human-driven markets. This is nothing new. If you look at Extraordinary Popular Delusions is a great book by Charles Mackay, and in the beginning of that book, he talks about money manias, and two that he touches on over the last 300 years are the South Sea bubble and the Mississippi scheme. And everyone should buy that book and read just those two sections at least, the Mississippi scheme and the South Sea bubble, and you'll quickly come to the realization that bubbles and manias are a core feature of markets, and especially markets where there is a credit cycle, which is usually driven by central bank or centralized monetary control of the fiduciary media. And so this is nothing new, exceptional to cryptocurrencies. It could be compared to the tech bubble in the 90s. It could be compared to the housing bubble in 07, 08. These are just a feature of how humans migrate to a credit boom and what ultimately happens in that space. So my thesis is this: cryptocurrencies are a mania, and cryptocurrencies are going to change the world forever. And those two statements are not mutually exclusive. And that is where the polarization of thinking of this space completely gets it wrong. And that's where polarization and politicization of anything leads to an inaccurate understanding, because people go all the way to one extreme or all the way to the other extreme. So I want to qualify this quite a bit. That we are both in a bubble, which I think is obvious on the surface, and that also that cryptocurrencies are going to change the world forever. And so as far as the changing of the world forever, I do think still today the most apt comparison is to the internet bubble in the 90s. The internet was going to change the world forever. We can now say that was definitely the case. But there was a huge bubble in the space. There were all sorts of .coms that weren't a business at all, that reached multi-million dollar, tens of million dollars in valuation. There was a complete mania, and then there was a total collapse and washout of the space. And even Jeff Bezos participated in this through his involvement with pets.com, which was really just the forerunner of Amazon.com that wiped out in that bubble. So I think that it's really clear that the technology of the internet and businesses moving online and commerce moving online and social media and all the things that have grown out of the internet have been world changing and mostly for the better. But we still had a mania, and we still had a complete disorder of markets and collapse that came from a credit boom and a credit bust, which is always a core feature that works hand in hand with manias. And I think that's a really important point too, is to note that cryptocurrencies today are not moving in isolation like maybe they were in the past. The size of the market is big enough that we can point to this as being a symptom of a larger credit boom and a credit cycle that is perhaps out of control, and we're seeing signs of this elsewhere too. So I think, again, the internet comparison is the best. If you look at the projects like Dogecoin and many others that I could name, these are basically tokens that are created in infinite quantity, and people pour into them by the hordes, causing a great price appreciation and then ultimately leading to a total price collapse. It is like the most quintessential bubble economics you could ever imagine. And so there are plenty of essentially worthless projects and protocols that go through this boom bust cycle, and it's just a confirmation that we're in this unsustainable bubble of space. However, the other side of that is that there are protocols in the cryptocurrency space that are going to change the world forever, and are actually in the process of doing that. And that the applications are already launched and live. These are no longer ideas. These things are happening in real time. So I'm actually going to ignore Bitcoin for this conversation. Bitcoin is a protocol that's based simply on creating maybe a currency or a store of value that has a limited supply, and people believe in it for that purpose. And that's kind of the beginning and end of Bitcoin. And I could say all sorts of things about the Bitcoin space, but it's far less interesting than what's going on outside of and separate from Bitcoin. And this is one of these cases where you hear people on Bloomberg and they make these statements about cryptocurrencies, and they paint the space broadly as being identical. And they say that a stable coin and Bitcoin and a lending protocol and an application protocol are all just this sweeping statement, the same thing. And that could not be further from the truth. The different protocols and cryptocurrencies are essentially wildly different in nature, and their use cases are wildly different. And so understanding some of these top use cases is really critical to understanding this space. I'm not saying you need a huge depth of understanding. You simply need to understand it 1 degree deeper than the talking heads, and to be able to cut through the noise. Having just a little bit of depth of understanding is hugely valuable. And so I'm going to try to provide that here in the next 15 minutes. So I want to look at 3 different types of protocols and how they are going to change the world forever. Whether it is these exact protocols as they exist today or a future version of these is yet to be seen. And more likely, it's a future version of what we're seeing today. Maybe we're seeing the Yahoos of .coms of the world, and the Google.com is yet to come. That is most likely where we are. We're so early. There's so much talent coming into the space. It's so green. The rate of change is ridiculously rapid. And so there's going to be improved iterations of all the things, the 3 things specifically that I'm going to describe today. There should be improved iterations of these on, and maybe only 1 or 2 of the current thousands of projects out there today actually exist 5 to 10 years from now. So that's an important caveat, but the ideas here are critical. So the most interesting one is to look at something like borrowing and lending, and as it exists in the banking system today versus as it exists as a cryptocurrency through a borrowing and lending protocol. Ignoring the depth of what the protocol is and how the blockchain works, This is essentially, you can think of it in the simplest terms as a website or a URL you can visit and accomplish a task. And the big difference is that there isn't a company that owns the site or owns the protocol. The URL is not owned by anyone in the sense that the underlying blockchain transactions are not owned by anyone. So borrowing and lending, this is the first subject, and it's the most important. The other two are fun and interesting, but this is the most critical in terms of how quickly we're approaching complete disruption of a current system. So currently, borrowing and lending works like this. Select banks have access to the Federal Reserve credit facility. The Fed lends to them at the Fed funds rate, which is 0.25%. So a bank borrows at 0.25% and then lends to you and I at 3, 4, 5, 6, 7, 8%. They capture the difference, and that's it. I mean, yes, there is more mechanics to it all, but that is essentially what works today. Banks are grifters. They have a great system because the Federal Reserve does not offer this lending to everyone. They offer this lending to very select banks. And so a handful of the biggest household name banks, the Wells Fargos, the Bank of Americas, they simply borrow at 0.25% from the lender of last resort that can create infinite money. And then they lend it to us at a much higher interest rate, and they capture all the difference. And that's why when you drive down the skyline of major cities, some of the largest buildings where all the wealth is captured is banking institutions, which are really not creating anything, not building anything, providing very little to no value to the greater economy or to the greater good. So how are cryptocurrencies going to address this? Well, the way this works today and the way it could look in the future is like this. There is a protocol currently that facilitates borrowing and lending with no middleman. I can go and lend and someone else can borrow, and there is no one in the middle that's capturing the margin difference. So right now, rates that you might see that don't require a lockup period, I can go and lend $100,000 and I can get a 7 to 8% interest on that. Much better than your bank's going to give you. Remember, the bank's going to give you 0 to maybe 0.5% if you're lucky interest on your deposits. I can make a deposit into this protocol and receive 7 to 8%. To make this deposit, I use something called a stable coin, which always maintains a one-to-one peg with a dollar. So it is no different than $1 of currency. It's $1 of USDC or USDT, one of these stable coins. So I make my deposit using a stable coin, which maintains its exact value as if it were dollars, and I can get paid 5, 6, 7, 8%. And on the other side, someone can borrow at 7, 8, 9%. There is a little bit of a margin there, and I'll discuss that in a minute. So immediately, all of the wasted value that has been captured by banks that pay bureaucrats and people sitting behind desks doing nothing to add value to the economy has been eliminated from the equation. That is profoundly positive. Furthermore, the way these protocols work today is actually 1,000 times safer than the borrowing and lending that goes on in the broader economy. The way the protocols work today is by over-collateralization. If I want to borrow through this said protocol, and again, I just go to the URL, I can borrow at 7, 8, 9% maybe, but I have to have 100% collateralization. So if I want to borrow $100,000, I put up $100,000. And maybe I put up $100,000 in a crypto asset that's going to continue to appreciate, hopefully. And then I borrow another $100,000 and I've created leverage. Usually, these actually require over collateralization. So I have to put up 125,000 to borrow 100,000. This is because it's in the early days and everything is built to be ultra safe. So the way this works without a middleman is that if my collateral that I've put up, my 100,000 or my 125,000, dips below 100%, a smart contract, which is just an automated system on the blockchain, a smart contract closes the loan and returns it to the lender. So again, this means if my collateral goes down in value, rather than the guy on the other side that has lent the money being out X dollars, there is essentially 100% protection for the lender. So the lender has almost, I would say 99% plus protection against loan default, and they can deposit and gain 5, 6, 7, 8% interest. Well north of anything you get from the current banking system. This is the value that is created when you take the middleman out of the equation. And decentralization and smart contracts is all about removing middlemen. And finance is where the most waste of capital and the biggest diversion of productive capital in the entire economy is without a doubt through middlemen in the financial sector. It is an incredibly inefficient system, and it is squarely in the crosshairs of many protocols that will absolutely eliminate the need for the middleman and enrich the people on both sides of the equation by the guy in the middle of the table no longer taking a chunk out of the middle of the value being exchanged by the two individuals. Now, I mentioned some subtleties, like there is a margin maybe between the depositor gets paid 5% and the borrower borrows at 7%, say something like this, so there's a 2% margin. This margin is paid back to the protocol, which this is a little bit in the weeds, but essentially anyone and everyone can own part of the protocol. And this is by maybe buying the cryptocurrency. And this is a way to facilitate people essentially validating that the transactions are good on both sides, making sure there's no double spending, making sure the smart contracts are executing as they should. And if anyone that provides computing power to ensure that that happens gets paid the small difference. You or I or anyone on the street can go and own part of this protocol. We can go and lend into this protocol, or we can go and borrow from this protocol. No more banking middlemen. This is profound. It is going to absolutely change the way the financial sector works. So that's just borrowing and lending. I would like to take it a step further now and use the really famous example in financial markets of what happened with Gamestop. Gamestop, which was another bubble phenomenon, was a stock that was completely washed out as GameStop was looking at something near bankruptcy due to the fact that COVID, of course, dramatically depressed demand for brick and mortar. People are buying games digitally and downloading them so they don't need to go to a store and buy the physical media. So GameStop, perhaps a business on its way out. Well, it was met with the mania, again, other signs that we're in this credit boom mania. It was met with the mania of a herd of individuals, some through Reddit and other social media platforms, that came together and led to this precipitous price blow off. It went straight up, and everyone that was betting on it to go down, shorting GameStop, got completely washed out, or most everyone, not everyone. So there are a few things that happen, underlying factors in what happened with GameStop that would look very different in the decentralized world. And so this is yet another example of how cryptocurrencies and decentralized finance which is a type of cryptocurrency, a protocol. The way decentralized finance, again, is going to completely disrupt a very inefficient financial sector in the United States and broadly across the globe. So in order to examine a little bit further the GameStop scenario, I'm going to have to go a little bit more into the weeds with the current financial sector. So if you're less interested in this, you can skip ahead. The section should be split up on the time bar if you're on YouTube. So with GameStop, the real story was between people that were long betting on the stock to go up and people that were shorting, betting on the stock to go down. So a feature of the current financial system that is not digital is T+2 settlement and custody of securities not being with the purported owner of those securities. So what does this mean? If I buy GameStop shares, I do not really custody or own those shares. Maybe my exchange doesn't even necessarily own those shares, but someone above them gets them. Plus, when I execute that trade, it takes 3 days before the shares actually change hands and end up where they should, which is absurdly antiquated. And if you there's a famous case study on Dill Fruits where shares were unaccounted for due to this delayed settlement system, and it created all sorts of madness and a lawsuit. But that's another story. So with GameStop, there highlighted a problem, or a problem was highlighted around custody of securities. So when somebody wants to short a security, they have to borrow it, sell it at today's price, and then buy it back and return it. That is basically shorting 101, outside of naked shorting, which I'll touch on momentarily. So in order for someone to bet on the price to go down and apply downward price pressure through shorting, they must borrow the share from someone else and sell it today. So many people had piled into GameStop that the shares outstanding were very limited. And so what was happening is people, let's say hypothetically me, which I promise you I would have nothing to do with this madness, but I maybe bought the share and held it with the expectation of it going up. But little did I know, since I don't actually own or custody the share, the brokerage or the custody entity actually took my share and lent it to the person betting on it going down so they could short it and put downward pressure on it. So little did I know, I was actually party to the process of someone speculating that it was going to crash and selling my share to put downward pressure on the stock. Why would someone that owns the share, that is looking for appreciation, ever agree to that scenario? And then why does the brokerage or the person that holds the share that you think or I think I own, why do they allow this to happen? Well, simple. The brokerage makes interest when they borrow the shares. So they make money on the shares that I supposedly own by lending it out for someone to short it. What a ridiculously upside down process. Why do I not own the security that I have supposedly paid for? Well, in cryptocurrencies, you do. In cryptocurrencies, there is 100% real-time settlement on the blockchain, and every individual can own their private keys, which is essentially saying they own the protocol or the security or whatever it is. So they do not have to allow this to be lent out to someone else for shorting or any other purpose. But if GameStop were something on the blockchain, and this example was in the cryptocurrency space, you could essentially say, I want to put up my security for someone else to be able to borrow it and short it, but I will get paid the interest in that scenario. Or I want to hold it and not make it available. This is why custody is so critical, And it's yet another thing that is addressed by the cryptocurrency protocols, where the legacy financial system, unbeknownst to the individuals that think they own the securities, are actually working against them and making money in the process. People do not understand that they're getting the shaft. And again, this is something addressed by cryptocurrencies and decentralized blockchain protocols. And this is why, again, there is a massive wave of disruption coming that is going to upend the likes of brokerage houses, the likes of Robinhood, et cetera, et cetera. This ultimately will move to a decentralized space where you no longer have a middleman that may or may not be working in the best interest of the individual. Code is what runs cryptocurrency protocols. Code does not choose to favor one party versus another. It is simply a set of rules and guidelines, and it is transparent and capable of being fair to all. So again, the financial sector is where there is the most middleman gaming, the largest diversion of productive capital, and decentralized finance, a subset of cryptocurrencies, not all cryptocurrencies, not Dogecoin, not even Bitcoin, but decentralized finance are a set of protocols that are going to completely disrupt the legacy financial system. And it's happening today. The borrowing and lending is out there. A brand new derivatives platform where you can trade securities is being launched as we speak. These things are happening. Yes, the space is going to wipe out. There is going to continue to be boom bust cycles as we are still somewhere in the midst of a mania, but the underlying technology is going to change the world forever. It is going to happen. It is happening. And it's really important to understand where it's happening first, which is through decentralized finance and upending the current middleman system of our financial system. So that is the most profound. Now for a lighter couple of notes, and these will be quick and hopefully more interesting if you're not as into finance. But I want to give two other examples of how cryptocurrencies can change the world. And one of them is through insurance, and the other one is through something called NFTs, which you have heard of. If you have heard of NFTs, you probably think it's the most ridiculous, bubbly part of this whole space. But I'm actually going to tell you something very interesting about how NFTs, non-fungible tokens, can be used in the real world to bring something really positive to artists. So first, insurance companies. And this is just a quick note. Decentralized blockchain applications, cryptocurrency protocols, these are disrupting middlemen scenarios and middlemen driven industries where someone is raking something out of the middle between two parties, and the person in the middle isn't necessarily needed but is protected by regulation or some other mechanism. So insurance, while it is not exclusively part of the financial sector, is another system of middlemen. And if you turn on the TV or listen to the radio or get on social media, you will be blasted incessantly by advertisements for insurance companies. If you drive and look at the cityscape, kind of like the financial institutions of major cities, you will see giant buildings with thousands of people working away at insurance companies. Insurance companies are really just facilitating math. There is math that is measuring risk, and I buy a policy, and therefore I'm an owner of the insurance. And when others cash in on their policy, it affects my premiums. There is very little reason why some degree of decentralization won't come to this space. And in fact, it already is. there are now protocols that are offering real insurance policies for a variety of things, and the actuary sciences, that is the math that makes it all work, is part of the code. Actuary, somebody correct me on that. And that no longer is going to require middlemen. And somewhere after decentralized finance takes over the world, insurance is next, and on and on and on. But these are two places where there is an inordinate amount of value locked up in an industry where there is a middleman between two people that are really exchanging and don't need someone in the middle taking as much of a chunk out of the middle, at least. So finally, I want to touch on NFTs, and really just one example, because non-fungible tokens right now it is riddled with total madness of mania and booms, and people are paying millions of dollars for digital assets like a tweet or something like that, or a piece of digital art. And you can argue all day whether or not that should make any sense. Maybe very young individuals will say, yes, I live in a digital world. Digital assets are valuable to me. Older people will never understand it. I don't know what the answer is, but I will give you one example where NFTs, non-fungible tokens, and never mind the total definition of what that is, I'll give you an example that'll make it clear, could provide a profoundly positive impact to the world. So the thing about blockchains and cryptocurrencies is that each individual transaction, or in this case, non-fungible token, is a representation of something unique on the blockchain that cannot be duplicated. So it is one unique individual item that is verifiably unique and cannot be counterfeited, because there is a blockchain and it validates the uniqueness of token 123 or ABC or whatever it is. So a non-fungible token is just a representation of this unique transaction on the blockchain. And a place where non-fungible tokens absolutely have a place is in ticketing. And I mean ticketing for something like a concert. So today, there are all sorts of middlemen, like Ticketmaster or Live Nation now, as they're called, that make tons of money by booking an artist at a venue and then putting tons of fees on top of every ticket that is sold. So they take a tremendous amount of profit away from the artist and feed a giant bureaucracy that provides very little actual value to the artist. Yes, there's some booking and some promotion that might take place, but it is highly inefficient. So an NFT is a perfect proxy for a concert ticket, because one can be issued and it cannot be duplicated, and it's perfectly verifiable. And it could be represented as something on your phone, like a barcode on your phone is essentially going to represent this unique NFT. And only I can choose to transfer that barcode to someone else, which brings up another good point about how NFTs can apply to this space. So what this means is that an artist can take total ownership of their tickets to a concert and say, hey, I'm having a concert in Atlanta, Georgia at a particular venue, and I am going to issue 10,000 tickets myself. People can buy them directly from me. I issue it to them. There are no fees and no middleman, and there can be no counterfeiting. It is just as secure, if not more secure, than anything a middleman could offer. And I shouldn't say just as or more. It is more secure because of the blockchain technology. So there's an additional layer to this. With an NFT, you have perfect visibility to everywhere it travels. So scalpers today serve another middleman purpose, where a scalper may buy a ticket for $100, but because of a small venue, the ticket skyrockets to $1,000 in value. and the scalper sells it and they capture $900, and the artist gets none of that appreciation. Well, with NFTs, you can incorporate a royalty back to the artist for every transfer. So when someone says, I'm going to sell this for twice as much, maybe the artist decides to put a 50% royalty. So the scalper, yes, maybe they capture half of the additional proceeds, but the artist also appreciates from the proceeds. This is a hugely positive thing for artists that has simply never existed before. There was no way to disintermediate or for the artist to participate in the transfer of the ticket on a secondary market. So eliminate all of the additional fees that ultimately get passed on to the fans that want to go and see the concert. Provide all of the value to the artist. And then when there is a resale of the tickets, the artist also benefits. Why won't this happen? There is no reason. NFTs will take over the space of ticket issuance, and it is profoundly positive for content creators, artists, and anyone that relies on ticket sales as part of their making a living. More wealth will be handed between the fans and the artists without middlemen taking a chunk for themselves. That is profoundly positive disruption. It is happening, and it's yet another way that cryptocurrencies, despite all of the bubble and the mania that's going on in the space, are going to change the world through disruption of middlemen and through the technology that is decentralized blockchains. So this has gone on long enough. I hope that I've provided some value to people that have had any interest in the space. I'm not going to tell you to go and buy certain cryptocurrencies or sell certain cryptocurrencies, or is the bubble over or is it going higher? I'll leave that up to you to speculate. Nobody knows. And very likely, again, there is going to be a total washout, and projects you've never even heard of will crop up and be even better than the current iteration. But this is all really positive stuff, and it's important to recognize that a mania bubble and a technology that's going to change the world are not mutually exclusive. So again, this is Jordan Lawrence of the Lawrence Perspective, and thanks for taking the time to listen.